Hello and welcome. You're tuned into CNBC TV18 Prime. Let's get cracking on a brand new edition of The Big C with me, Manisha Gupta and Nigel D'Souza. Your daily dose of commodities, cryptos and currencies. But what are we focusing on today, Nigel?
Well, plenty, right? It's going to be a power-packed show that we have lined up today. First up, we'll be speaking to Claudio Galimberti of Rystad Energy to understand where the money markets as well as the commodities like oil as well as gold are headed amid the flaring tensions between Israel as well as Iran.
Not just that, we will also put spotlight on diamond market with Amit Pratihari of the Beers Forevermark.
Well, first up, let's do a quick check on what's going on with the equity markets. Now, stocks on Wall Street, they closed lower on Friday, with the key indices correcting close to under 1% apiece. That's due to the rapidly escalating conflict between Israel as well as on Iran. However, the US stock futures, they are higher as of this afternoon. That's more or less in line with what Asian markets are doing. They're all set to go to close well in the green. Now, apart from the conflict in West Asia, investors are also going to be tracking what's going on in terms of central bank action. And there's plenty this week. The US Federal Reserve will announce its interest rate decision later this week, with the street expecting a status quo on rates, though the commentary from the Fed chairman is something that we'll be tracking. The Bank of Japan, Bank of England, as well as the central banks of Switzerland and Brazil will also be announcing their policy decisions later this week. Now, given the context of the conflict between Israel as well as Iran, investors, well, they'll be keenly watching out for OPEC's monthly report. That's going to be released later today as well. Also, an alert for investors, Wall Street will be closed later this week on Thursday due to Juneteenth holiday as well. So a bit of a breather coming in for them.
Oh, well, absolutely. And stocks in Asia Pacific largely are higher. Nikkei closed with good gains for over a percentage, and Shanghai too shut shop higher by 0.3%. Back home on Dalal Street, the Nifty is nearly up a percentage point this time and nearing those 25,000 levels and struggling because of the global tensions there. Well, a quick check on the currency markets then, and the greenback that's been rallying as the Israel-Iran conflict triggered a wave of safe haven buying across markets. The sudden flare-up has injected fresh volatility in the global markets, with traders scrambling for safety in the dollar, gold and treasuries. Meanwhile, crude has also been on an up move after the two conflicting countries attack each other's energy infrastructures. Iran has also indicated that it may shut down Strait of Hormuz. Well, that really is something that it has been saying for the last 3 days now, a key global transit route, raising additional concerns over supply disruptions. The Swiss franc is also near its highest level since 2011. In addition to geopolitical tensions and risk reversal, other factors have contributed to the franc's strength, which is up almost 10% so far in this year. These include uncertainty surrounding the President Trump's trade policies and broad-based dollar weakness triggered by cooler inflation and growing concerns over the U.S. economic and fiscal outlook. On the other hand, the British pound eased after hitting a 3-year high. The euro eased after hitting 1.16 as well. This has been a 3.5-year high that we saw euro check on the higher side too. As promised then, let's take this discussion forward with Claudio Galimberti. He's the chief economist at Rystad Energy. Claudio, hi, good to have you. And there's just so much happening in the international markets right now. A lot of experts that we speak to tell us that it's the first time in their career that they've seen almost everything happen at the same time. I want to start with macros first, and we've been dealing with tariffs, and now we're dealing with geopolitical tensions as well. The kind of premium that we've seen in crude oil prices in the previous week and currently right now, how are you reading that?
Thank you for inviting me here, first time, and coincidentally, I'm in India today, so that's very good. What I say is that what we saw over the weekend was almost unprecedented, right? So if I make a comparison, the invasion of Ukraine comes to my mind, and of course, the Hamas attack on Israel. So this is when I look at the market volatility, this is the two events that I compare it to. But the most important thing is that it does look to be persistent. So the market reaction is not going away as of today. So the Brent price still hovers around $75 per barrel, which means that the geopolitical risk premium embedded in oil right now is close to $10 per barrel, which is quite high. So you need to go back in time. I mean, it would be the invasion of Ukraine. It was even higher back then. And then you need to go back to episodes in the past that happened in some cases 30, 35 years ago. So from that standpoint, for sure, we are seeing something very epochal to some extent, seismic, and it can bring about a lot of change. But a lot of stuff is still going on. Therefore, this is clearly the recipe for volatility in the market. The market tries to understand where events are going, and that intrinsically generates a lot of volatility. So very good for traders, right? Very good for traders.
All right. Hi, Claudio, and good to see you on the show. This is Nigel on this side. A quick question with regard to the crude oil spike, right? Because initially it was dancing away to around the $80 per barrel mark, but it's cooled off from there. I think given the underlying demand trend itself is a little bit weakish, do you think, on the higher side, if it doesn't escalate from here on, the tensions, do you think $80, $85 handle is a near-term peak for crude oil prices, or do you think it can spike past that?
I think that the big elephant in the room is the Strait of Hormuz, right? So this is a choke point, probably the most important choke point in the entire supply chain of oil. Roughly 30% of the oil that is traded on ships around the world goes through the Strait of Hormuz, 30%, right? So we're talking about close to 18, 19 million barrels per day. And LNG, by the way, LNG is roughly 20% of the global LNG goes through the Strait of Hormuz. Now, geographically, where does this sit? Between Iran and the United Emirates / Oman, and Qatar. So this is, therefore, it's very sensitive. Historically, though, the Strait of Hormuz has never been blocked. So it's such an important choke point that the United States Navy and obviously even further back in the past, it was always patrolled and always ensured that the oil would flow, even during the Iraq-Iran war in the 1980s. So if you ask me, can oil go above that? Well, if something happened to the Strait of Hormuz and some of that oil is is constricted, cannot go through, then I would say yes, then we could be much, much higher than $85 per barrel. But you raised a very important point, which is the underlying demand outlook that we have seen so far this year for a variety of reasons. Tariffs would be probably the most important factor, has been underwhelming. So the demand outlook is not particularly conducive to a very strong rally.
Oh, absolutely. Claudio, just taking that point further, while Strait of Hormuz has been threatened about a lot of times that it can be shut, and as you said, it never really has been done. Do you think this time is any different, or is it just a negotiation point right now?
There is a war, unfortunately, going on. So the one between Israel and Iran is all the hallmarks of a war, right? So 100 missiles launched as a response to some key military figure being killed by Israel. So we're talking about a fully fledged war. With the war comes what I call the fog of war, right? So you cannot really predict how a conflict is going to go. There are too many unpredictable factors and variables. Now, what we know, this is the starting point, is that Iran's crude flows almost entirely to China. Therefore, Iran, the key ally of Iran in all this conflict has always been China, right? China and to some extent Russia. So China would hurt, China's economy would hurt tremendously if the oil prices were to spike. And if the Strait of Hormuz is shut, then the oil prices would be extremely high. From this standpoint, you see that Iran would be completely by itself in trying to blockade the Strait of Hormuz. So you would have pretty much the United States, China being on the same side, trying to prevent that from happening. And that puts the likelihood of a blockade in a very low range.
Claudio, just for the good of humanity, I just hope that things de-escalate from here, but let's see how that goes on that front. That said, in times of uncertainty, You normally see a flight to safety. You'll see the dollar index strengthen a little bit. There'll be a lot of demand for US bonds as well. But this time around, that hasn't happened, how we have seen in the past. What are you making of this with regard to the moves on the dollar index as well as the lack of demand for US bonds?
Absolutely. That's a mega trend that we began to see in full force on April 2nd, right? The famous Liberation Day announced by Trump with the tariffs that introduced a degree of uncertainty in the market that generated a discount on all the US assets, starting with the government bonds, reason being on top of the tariffs, which has been the whole tariffs kind of policy has been gradually scaled back. Now, we're not out of the woods yet, so we need to be aware that the level of tariffs that are currently in place, and it feels like the tariffs conversation is over, but the level of tariffs is almost 10 times as high as it was at the beginning of the year. So that is a problem for the economy. But the additional problem is that there was also the big beautiful bill that the Trump administration announced just a couple of weeks ago that contained a lot of provisions that are supposed to swell the deficit quite dramatically, right? And the deficit is already at a very high level. That generates a degree of riskiness for US assets, specifically for the government, for the bonds, which we didn't see in the past. Now, that's the reason why they are discounted when it comes to the pricing, and therefore you see government bond yields going up, right? There is the flight to safety right now occurs not so much by buying U.S. assets, but by buying gold.
Gold, yes.
If I look at gold, the performance of gold has been astonishing. It's been the best kind of asset class that since for the past 6 months, and that's for a variety of reasons. First is that gold is obviously as a safe asset, perceived as a safe asset, and the second is also always an edge against inflation. And tariffs are supposed to bring about inflation. Albeit, and this is very important for us to understand, the tariffs have not made it into the inflation number yet. So the inflation published last week in the United States was actually quite subdued, something like 2.4%, which was just 0.1% higher than the previous month. So there is a strong expectation that tariffs will bring about inflation, and that's the reason why investors are buying gold. But so far, tariffs have not made it into the inflation number yet.
Clearly that. So, Claudio, what is Rystad Energy's house view when it comes to dollar and perhaps the crude oil prices going ahead, even gold for that matter? What are the best case scenarios that you're working with going forward for the rest of 2025?
Well, the degree of, so when we're talking about house view is more on the longer term, so how the energy system will evolve. But on the shorter term, we need to be aware that there are very many factors right now that are very difficult to predict. I talked about just a few minutes about the fog of war. Now, setting aside for a second the huge geopolitical risk premium that we have, what we see in the second half of the year for the oil markets is length. What I mean by that is the supply of oil is supposed to sit above demand for quite a few months, specifically in the final part of the year. That's due to a variety of things, the most important of which is the structural increase in supply coming from specifically Latin America and Canada. So that is something very important for when it comes to OPEC, because OPEC will need to make a decision, a very critical decision, come September and October, whether to continue to unwind their cuts or to stop and potentially even reverse if they want to keep the oil prices at a certain level. But these, of course, assumes that the situation normalizes, the situation in the Middle East normalizes.
No. So, Claudio, just interjecting in, there are some reports suggesting that if things worsen from here, then we are perhaps going to 85, even a triple digit. And if everything normalizes, and as you mentioned, the demand is not so great, we could be going down back to 60 or even 50, then there are various case scenarios playing out. How would you look at the prices? How many case scenarios are you looking at?
We're looking about a few scenarios, at least two, right? So we have one which is completely fundamentally driven, and in that, our assumption is that our projection is that prices indeed would fall below $50 per barrel, and the reason is that there is too much supply, specifically starting in October. Our expectation is that OPEC will want to maintain prices within a certain range. Let's call it between 65 and 75, which is our price focus for the rest of the year. If that is the case, if we are correct in assuming that, then implicitly OPEC will need to start cutting back on their supply in the fourth quarter of this year and continue even next year. So very, very complex decision by OPEC Plus.
Oh, absolutely. There are just so many scenarios playing out. But we do understand, as you said, 65 to 75 seems like a range right now if things start to peter down there. Claudio, thank you so much for joining in today at CNBC. And we hope you enjoy your India visit rather. Thank you so much.
Absolutely.
And with that, it's time now for a short break. On the other side, we are joined by Amit Pratihari of the Beers Forevermark. Stay tuned. Welcome back, and joining us now is Amit Pratihari. He's MD at Beers Forevermark. Amit, hi. My first question to you is, how has the year been for you until now? Because we do understand the last couple of years did not augur so well in sense of prices or demand for that matter. But this year clearly has been different because of various milestones, especially for you, the way you have been campaigning for natural diamonds. We've seen the prices gain up as well. And then you have put out a record quantity of money for campaigning and marketing for natural diamonds.
I think until now is quite promising from many ways. If you look at how De Beers is reshaping the diamond desire, it's critical to understand the impact also. So we started this year with a strong campaign, on a various way. One was that we tied up with Tanishq, which was a big partnership announcement in the beginning of the year. We launched Indra project, which is with GJPC, and also at the same time we have started our generic campaign, and that was the first one was the second piercing. So if you look back, De Beers is doing this initiative after a long gap. So basically our commitment to promote natural diamond in India has gone multifold, and we're getting a very, very good response out of it. So so I think the year started very well. We are meeting our KPIs, that is more important, and looking forward to next phase of the year.
All right. Hi, Amit. Thanks a lot for joining in. Well, help us understand this a little bit better. The second piercing campaign. Tell us more about it.
Second piercing, if you look at Manisha, when we were thinking about generic campaign, what is that we need to do? So if you remember, in US we had already started our generic natural diamond campaign from De Beers. Our thought was that we need to do a generic campaign which has a cultural relevance and has a meaning to our rituals. Like in India, we just don't wear jewelry for adornment. Also a celebration of milestone and some emotional meaning to all. It has always an emotional meaning to it. So when the team was deciding on this, I think whole credit goes to the team. We were thinking, how we can think of a concept which is part of our ritual, and that's where the idea of second piercing, originated. If you look at when the daughter, I have a 13-year-old daughter now. And when I remember the first piercing was done to her when she was not even in her senses, 2 months she was, and we did a first piercing happen. But now she is growing up as a teen, and I can see her taking her own independent decision. Maybe it is playing little bit basketball for extra hour or doing some fun with her friends. So these are the decisions what she is taking. And second piercing is that one major decision what she takes for herself. And in this process, what we have done is that most of the time you talk a relationship between a mother and daughter, but we shifted the lens from a dad's view, how they look at, when the daughter grows, starts taking her independent decision in her life, and how a dad view is about that relationship. So I think second piercing is such an beautiful ritual in Indian context. It has a very strong emotional meaning, and a dad is narrating whole story of it. So I think it's an amazingly curated concept, and we are getting a very very positive response. And the moment is so special and so natural. The bond between a dad and the daughter, that only a natural diamond can represent it, has been articulated very well.
Amit, I'm assuming second piercing is fine. It's the third and the fourth piercing and a natural diamond requirement for that Nigel perhaps would become a bit of a concern. But Amit, also comment on how De Beers is now looking at various colored diamonds as well within the natural space also. I mean, as you said, the campaign has come in after a long time and you're really pushing in all sides here. There were also reports on how De Beers is pushing for brown and yellow diamonds. How are you looking at the overall market for these?
So I think, we are coming up with a concept, so if you look at diamonds, it takes billions of years to form under Mother Earth. And diamonds are not just formed under the earth, but you can find diamond under the ice, wherein we have mines in Canada. And we have also, diamonds are found under seabed. So when you say this diamonds, because of the nature where it is formed, the shapes are very different. Okay. So brown diamond is just not that we are promoting a brown diamond. We are promoting a concept. So basically, there is a tinge of brown in the diamonds, which comes from deserts. Okay. So from the land. So basically, we are talking about the natural beauty of that particular category based on the origin of the diamond. So that is the whole concept of, pushing, not say brown diamond, because once it is cut and polished, you cannot find any difference, but bringing the concept of origin on based on where it is formed.
Interesting point, Amit. But let's get to the trends globally then. What's been the latest out there? While we do understand that tariffs may not impact as much, but the way the global reset is taking place, a lot of changes and uncertainty across currencies, do you see an impact on the diamond industry?
So yes, tariff will have an impact, but I think the government is doing a pretty good job in those negotiations, and I'm sure it will be resolved very very quickly. That is a short-term impact, but the good thing about it is that when you look at a long-term view, there is some early sign of positivity. And from an Indian context, I can tell Manisha, we are growing double-digit in this market, and we see this momentum continue for next decade or so, because in spite of diamond been so well accepted in India, diamond penetration is less than 10%. So that is a huge opportunity for this category to grow.
Well, that point is well taken, Amit. As you said, the Indian penetration has been quite strong, increasing as well. And when you talk about numbers, well, yes, India is the largest exporter when it comes for diamonds. India is the second largest consumer for diamond jewelry as well currently now. How would you say is the penetration right now? What is the kind of growth that we may see over the coming years? What has been the context last year as well? And also, when are you looking at the other markets in terms of US and China? I mean, we did see a bit of a decline into that in the last year. How are you taking stock of all of these markets together?
From an Indian market point of view, if you look at the whole jewelry market, it is around total, I'm just saying, that includes gold and, of course, diamond altogether, natural diamond altogether. So the market is around $90 billion. Okay, diamond jewelry per se, it is slightly under $10 billion. So even in the growing market, the diamond penetration is only close to 10%. The prediction is that by 2030 it is going to be $18 billion. So technically it is doubling, almost doubling in next 5 years. And that growth is primarily driven by the organized retail, wherein brands are expanding, Tanishq, Malabar, Joyluka, these are the brands who are expanding because of the new retail infrastructure coming in the market, the new economy, the growing middle class income. So there is an appetite for diamond jewelry per se. So, and I don't see anything slowing down for next couple of years. And our objective, is to push natural diamond penetration from 10% to 15% in next 5 years. Looking at the global market, to your other question, yes, times are a little bit, unpredictable because of the geopolitical situation. But fact remains the same that there is also an opportunity. Of course, China is slowing down, but we are seeing some early sign that some correction is happening. Some movements are already happening. There is already a demand for smaller size of diamond, and America, which is USA, which is one of the largest market, almost consumes 50% of polished diamond, which JCK got just over. People are saying it was very, very positive one. That's the feedback which I got. And of course, this tariff thing, which will get resolved in some time.
Thank you for that, Amit. Well, that really is a push on diamonds, where we've seen strong penetration continue into India. And as you've told us, 10 to 15% of growth is what we're looking at in this year as well. Interestingly, Nigel, when you look at the diamond prices, the natural diamond prices, they fell 15% in 2023, 18% decline in 2024. That would have been a great time to buy diamonds, because now in 2025, the prices have gained up by 10% already.
And the lab-grown prices have fallen far more, Manisha,
Yes.
isn't it?
It has. But it all seems to be stabilizing right now. There are two different markets here, but the natural diamond industry absolutely seems to be pushing its best foot forward. They do want to sell natural diamonds, where we are looking at prices stabilizing and demand as well.
Well, it calls for some more research then on that front. Thanks a lot for that, Manisha. Well, on that note, though, we've completely run out of time on this edition of The Big C. Stay tuned to CNBC TV18 Prime for more news and updates. Thanks a lot for watching.